I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global media conglomerate. Media is changing, and those who can't adapt will struggle over the years to come. However, this company is adapting and is most certainly not struggling. To the contrary, thanks to an empire of terrific complementary assets, many of which are perfectly situated for new media, this company continues to grow its revenue, profit, and dividend like clockwork. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Comcast Corporation, which appear to be trading at a significant discount today. Comcast Corporation, stock ticker CMCSA, is a media and entertainment conglomerate with interests in cable, broadcasting, film, streaming, live entertainment, and theme parks. Founded in 1963, Comcast is now a $174 billion by market cap media juggernaut that employs more than 180,000 people. The company reports operations across 5 segments: cable communications, 55% of fiscal year 2022 revenue, media, 20%, Sky, 16%, theme parks, 7%, and studios, 2%. Cable communications consists of the operations of Comcast Cable, which provides millions of cable video connections, high-speed internet connections, and voice services connections. Media consists of NBC Universal's television and streaming platforms, including a variety of cable networks, the NBC Broadcast Network, the Telemundo Broadcast Network, certain television stations, and Peacock. Sky consists of the operations of Sky, a leading European entertainment company that creates content and provides video, broadband, voice, and wireless phone services. Studios consists of NBC Universal's film and television studio production and distribution operations, including Universal Pictures, one of the 5 major U.S. film production studios. Theme parks consists of the worldwide Universal theme parks. Comcast also has other business interests that consist primarily of the operations of Comcast Spectacor, which owns the Philadelphia Flyers and the Wells Fargo Center Arena in Philadelphia, Pennsylvania. We know that media is changing in ways that do not necessarily benefit the traditional gatekeepers. Streaming has already taken over a landscape that was previously dominated by over-the-top cable TV packages. And if that's all Comcast had to offer, it'd be a business model in trouble. However, that's far from reality. Comcast is a conglomerate that touches nearly every part of media. Yes, there is still a cable TV distribution offering in there, but Comcast has built a streaming platform of its own called Peacock, which now claims 28 million customers after recently growing its paid subscriber base by 80% year over year. Moreover, Comcast has sports, news, theme parks, and television and movie production. Perhaps most importantly, it's the dominant provider of broadband internet connections in the US. How dominant? Morningstar has this to say, and I quote, "Comcast cable business has steadily gained broadband market share over its primary competitors, phone companies like AT&T and Verizon, as high-quality internet access has become a staple utility. We estimate the firm has increased broadband market share in the areas it serves to about 65% from 50% a decade prior, meaning Comcast customer base in the typical market area is twice the size of its rivals," unquote. Demand for high-speed internet access is nearly insatiable, and that confers a certain amount of pricing power to a dominant player like Comcast. After all, you cannot stream or do much of anything else in this modern day society without a high-speed internet connection. I would go as far as saying that high-speed internet is almost as important and necessary as electricity in 2024. It's because of this broad diversification and dominant position in broadband that Comcast has been able to consistently grow straight through one of the most disruptive periods that media has ever seen. That growth, by the way, includes Comcast Dividend. Indeed, the company has increased its dividend for 16 consecutive years. The 10-year dividend growth rate is 13.3%, which is strong, but recent dividend raises have been in a high single-digit range of around 8%. Still, seeing as how the stock yields 2.7%, that's enough dividend growth to get the job done. This market-beating yield, by the way, is 50 basis points higher than its own 5-year average. And with a payout ratio of 32.3%, Comcast has plenty of headroom for more high single-digit dividend raises over the years to come. What I see is a well-balanced dividend profile here with a good yield, solid growth, and plenty of safety. Really just so much to like across the board. Looking at business growth, Comcast moved its revenue from $64.7 billion in fiscal year 2013 to $121.4 billion in fiscal year 2022. That's a compound annual growth rate of 7.2%. That's surprisingly impressive. I'm usually looking for a mid-single-digit top-line growth rate from a mature business like this. Make no mistake about it, Comcast is very mature. Despite its size and maturity, Comcast was able to move the revenue needle in a meaningful way. In the interim, the company grew its earnings per share from $1.28 to $3.64 adjusted over this period. That's a compound annual growth rate of 12.3%. Again, impressive stuff out of Comcast. This totally busts the narrative out there that Comcast is some kind of dying cable company. Dying companies don't compound earnings at 12% plus annually. To the contrary, Comcast has been growing faster than a lot of other higher profile businesses out there. It's important to note that I used adjusted EPS for fiscal year 2022. That's only because Comcast recorded non-cash impairment charges related to Sky during fiscal year 2022, which artificially skewed earnings per share results for the year. Also, we can see quite a bit of excess bottom line growth, and this was mostly driven by prolific share buybacks. Comcast reduced its outstanding share count by approximately 17% over the last decade. Looking forward, CFRA is projecting an 8% compound annual growth rate for Comcast earnings per share over the next 3 years. I like that. I think it's a pretty sober assessment of the reality of the business. CFRA does a good job of summing up a lot of it with this passage, and I quote, "We think Comcast results in the first half of 2023 showed a firming recovery path for TV/film content and theme parks businesses benefiting from pent-up demand. Meanwhile, with the cable broadband business recently riding some demand tailwinds, the company has increasingly pivoted to a broadband-led connectivity strategy and gained significant traction in its nascent wireless offering," unquote. This is a diversified media conglomerate with multiple levers to pull, and the levers are being pulled. A multi-pronged entertainment strategy spearheaded by Broadband positions the entire business well for continued changes across media. After all, it's impossible to consume all of that online content if one is not online, and this creates a demand funnel for Broadband. I'd also point out that this is a rare family-run business, as Brian Roberts, part of the founding Roberts family, runs Comcast as CEO and owns all of the company's B shares, giving Roberts about 1/3 of all voting control. It's not often to see so much quote-unquote skin in the game in a US company, as I usually see this much more often in foreign companies. Now, CFRA's 8% number would represent a pretty sizable drop in growth relative to what Comcast has put up over the last decade. However, I don't see a 12% plus compound annual growth rate as necessary or realistic for Comcast. Even just a high single-digit bottom-line growth rate driven by a combination of mid-single-digit revenue growth and share buybacks, that's enough to propel similar dividend growth, and you get to pair that kind of growth with the near 3% starting yield. It's a pretty straight path from there to an approximate 10% annualized total return out of the stock, assuming no serious changes in valuation. Nothing wrong with any of that at all, in my view. Comcast surely isn't dying, but it's also not going to provide world-beating performance. If you have reasonable expectations, Comcast should be a very good investment over the coming years. Moving over to the balance sheet, Comcast has a less than stellar financial position. The long-term debt-to-equity ratio is 1.2, while the interest coverage ratio is hovering around 6. Comcast ended fiscal year 2022 with nearly $100 billion in long-term debt, which is sizable and slightly concerning, even for a company with a market cap approaching $175 billion. That said, the balance sheet has improved slightly in recent years, as long-term debt was nearly $110 billion in fiscal year 2018. In my view, the balance sheet is easily the weakest and least desirable aspect of the business. Profitability is more than decent. Return on equity has averaged 13.6% over the last 5 years, while net margin has averaged 10.2%. The returns on capital aren't the highest out there, but Comcast is putting up respectable numbers. Notably, these 5-year averages would both be higher if not for the impairment that was recorded last fiscal year. Overall, I see a lot to like here. Comcast has assembled an empire of durable complementary assets that are positioned well for the changing landscape across media. And with economies of scale, high barriers to entry, and the ability to operate as a local monopoly in many markets, the business does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While the broader media industry is fiercely competitive, Comcast benefits from often being the only major cable player in any given market. Streaming TV is an existential threat to the cable bundle, but Comcast counters this with Peacock and Broadband because one cannot stream television without internet access. Cable television usage is in secular decline, and this disproportionately harms the company. It hurts both the distribution, that is cable video side of the business, and the production, that is networks side. Comcast faces technological obsolescence risk with competitors constantly trying to bring better, cheaper, and/or faster internet access options to market, with examples being 5G wireless and LEO satellites. The high debt load limits the company's future flexibility in terms of M&A and network buildouts. Comcast also has a poor reputation for customer service. I think these risks are worth serious consideration, but the underlying asset empire seems attractive enough to overcome the risks. Also, with the stock down about 30% from all-time highs, the valuation seems attractive. We have a PE ratio of 12 on the stock right now. That's about half of the broader market's earnings multiple. It's also well off of the stock's own 5-year average price-earnings ratio of 19.4. The cash flow multiple of 6.4 is also quite a bit lower than its own 5-year average of 7.7, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. I'm basically assuming a continuation of the status quo here. This growth rate is lower than the demonstrated EPS and dividend growth out of Comcast over the last decade, although it's pretty close to where recent dividend raises have been coming in at. I'm also slightly below where CFRA is at on the near-term forecast for earnings per share growth. With the payout ratio being as low as it is, the dividend growth could actually outpace earnings per share growth for a number of years. However, I'd rather err on the side of caution. CFRA might be too optimistic. Also, management may decide to take it easy on the dividend raises in order to address the balance sheet. Either way, the model accounts for some conservativeness. The dividend discount model analysis gives me a fair value of $49.88. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates CMCSA as a 4-star stock with a fair value estimate of $60. CFRA rates CMCSA as a 4-star buy with a 12-month target price of $50. I came out within pennies of where CFRA is at. Averaging the three numbers out gives us a final valuation of $53.29, which would indicate the stock is possibly 19% undervalued. Here's the bottom line, guys. Comcast Corporation has built a dynamic media conglomerate with an empire of durable complementary assets. In spite of the narrative around cable companies, Comcast shows surprising strength and growth. With a market-beating yield, a double-digit long-term dividend growth rate, a low payout ratio, more than 15 consecutive years of dividend increases, and the potential that shares are 19% undervalued, long-term dividend growth investors looking for media exposure ought to have this name on their radar. And now for a special news announcement. Starbucks Corporation, stock ticker SBUX, is adding new food items to its menu, including a chicken, maple butter, and egg sandwich. Is this a move to counter what McDonald's is doing with its new concept Cosmics? We don't know, but it does show that Starbucks isn't going to get left behind. Maintaining that sharp competitive edge is exactly what you want to see out of a large established business like this. Meanwhile, the stock remains at an undemanding level. Take a look. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check out the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.